Welcome back to the deep dive. It's Tuesday, January 20th, 2026, and I really hope you're sitting down or at least have a strong coffee in hand because the media landscape, it didn't just shift today. It completely broke off the continent and floated away. We're looking at a stack of papers here this is arguably the most significant day in Hollywood since the invention of TV.
It really is one of those remember where you were moments. Usually, when we look at earnings reports, we're looking for decimal points and minor adjustments. Today, we aren't just looking at a quarterly report. We're looking at a fundamental restructuring of the entire entertainment industry.
We're talking, of course, about Netflix's Q4 2025 earnings. They dropped today. But honestly, the earnings themselves, and they are impressive, we'll get to them, they're almost a footnote.
Almost, yeah. The headline news is just so much bigger.
Netflix is acquiring the studio and streaming assets of Warner Bros. Discovery. This is the big one.
It's the Project Popcorn deal. The one everyone whispered about at industry parties, but, nobody thought would actually happen. And our mission today is to unpack exactly what this all means. We're going to trace Netflix's transformation. They started as this cash-burning disruptor, right?
Mm-hmm.
Then they evolved into a media utility that everyone just has, like electricity. And now they're potentially morphing into this massive, debt-heavy conglomerate.
And to keep us grounded, because it's so easy to get swept up in the hype, we're pulling this deep dive from the Netflix Financial Research Report, dated today, and a strategic analysis that pits Netflix against the frameworks of legends like Warren Buffett and Peter Lynch.
Yeah.
Because when you're talking about numbers this big, you need a framework. You need some rules.
Absolutely.
Yeah.
You have to look past the glitzy press releases and get into the capital allocation. Because the numbers we're seeing today they're just staggering.
Staggering is the right word. Let's just hit the headlines to set the scene. We're looking at 325 million subscribers globally, over $12 billion in revenue in one quarter. But the real story is the price tag on this acquisition. We're talking about an $82.7 billion gamble.
It's a gamble on Batman, Harry Potter, and the Iron Throne. A bet on what we call forever IP.
Okay, so let's unpack this systematically. Section 1. The state of the streamer right now, the before picture. How did they actually do in Q4 2025? Because for so long, the story was just growth,
What?
but no cash.
In a word, dominant. If you look at the snapshot, revenue is up 18% year over year to $12.05 billion. Operating income is nearly $3 billion, up 30%. They're running at a 24.5% margin.
And just for context, legacy media companies are like bleeding out, trying to hit break even. Netflix has software company margins.
Exactly. And that 325 million paid memberships. I remember back in 2022, the Bears were saying they'd cap out at 250 million.
Probably we're up past it.
They did.
Yeah.
But for anyone tracking the long-term viability, and for you listeners trying to value this company, the most critical metric isn't subscribers anymore. It's the cash. For a decade, the knock on Netflix was the cash burn.
Right, that was the whole narrative. A house of cards. They were borrowing billions in junk debt to make Stranger Things, and eventually the bill would come due.
Exactly.
Okay.
But that narrative is, well, it's officially dead. In 2025, their free cash flow hit approximately $9 billion. This is a massive pivot. It's the concept of owner earnings finally coming true.
Okay, can you break down owner earnings for us? Because that's a specific Buffett term.
Sure. Think of it like building a huge factory. While you're building it, you're spending cash hand over fist. Your capital expenditures are massive. That was Netflix from, say, 2013 to 2022. They were building the global library. But now, the factory is built. The content library has reached a critical scale.
So the old hits, the early seasons of Bridgerton, stuff like that, they're already paid for.
Precisely. The amortization costs are in the past, but those shows keep retaining subscribers. The old hits are literally paying for the new ones. It's a flywheel. They don't need to borrow money just to keep the lights on anymore.
That's a huge milestone. It's like they finally paid off the mortgage. But there's another layer to this cash machine, isn't there? The ad tier.
Yes, and this is the Peter Lynch part of the story. Lynch always looked for that hidden asset, the growth engine inside a mature company.
I feel like we all complained about the ads when they launched. I certainly did. I'll never watch ads on Netflix.
And yet, the data shows we all did, or enough of us did. Ad revenue topped $1.5 billion in 2025. That's 2.5 times the growth from 2024. And the forecast in this report is for it to double again to about $3 billion in 2026.
That's incredible. So even if subscriber growth slows down, eventually you run out of people on Earth, they have this massive advertising business growing inside.
It's high margin, pure profit growth. It diversifies them. But, and there's always a but, just as they reach this financial nirvana, perfect balance sheet, huge cash flow, they decided to blow it all up.
Enter Project Popcorn.
$82.7 billion.
Okay, this is where I need you to break down the structure because it's not a clean buyout, right? I saw something about a spinco.
Right, and this is a crucial distinction. Netflix is smart. They know cable TV is a melting ice cube. So before the acquisition, Warner Bros. Discovery is spinning off its linear networks.
Wait, so CNN, TNT, the Discovery Channel, those aren't coming to Netflix?
Nope, they're being pushed into a new company called Discovery Global. Netflix isn't touching the cable news headaches, the declining affiliate fees. None of it.
That is incredibly strategic. They're just cherry-picking the good stuff.
Exactly. They're buying the Warner Bros. Studio lot, the literal history of Hollywood, and the Max streaming service, which includes HBO. They're buying the growth assets and leaving the dying ones behind.
Okay, so they get the studio, they get HBO, but I still have to play devil's advocate on the price. $82.7 billion is an astronomical number. Netflix already has volume. They have Squid Game. Why do they need Batman?
It all comes down to the forever IP thesis. And this is where the strategy shifts from being a tech company to being, well, being Disney. Netflix is the king of volume. Sure, they can make a hit for a month, but they lack multi-generational IP. They don't have a Mickey Mouse.
Stranger Things is ending. And honestly, after that, what do they have that I'm going to show my grandkids? Probably nothing.
Exactly. By acquiring Warner Bros., they get Harry Potter. They get Game of Thrones, Lord of the Rings, the entire DC universe. It creates what analysts in this report are calling a content fortress. The idea is to reduce churn to near zero.
I see. So if I'm a subscriber, I might cancel when Stranger Things is over. But if they have House of the Dragon coming next month and then a Batman movie?
You never leave. It becomes the default operating system for TV. If you have the best volume and the best prestige library, why would you ever unsubscribe? You'd cut your electricity first.
It sounds like a victory lap, but the report says it wasn't a walk in the park. There was some serious drama with Paramount.
Oh, huge drama. This was a bidding war. Paramount Skydance put in a hostile bid at $30 a share. Remember, Netflix is paying $27.75.
Wait, hold on. Netflix is paying less per share than the losing bidder. Why on earth would the board take a lower offer?
Because cash is king. The Paramount deal was a leveraged buyout. It was complex, involved a lot of debt, a lot of shaky stock. Netflix came in and said, here is an all-cash offer, certainty of value.
So in a volatile market, the board took the sure thing.
Certainty wins. But now, Netflix has to pay that cash.
Yeah.
And this leads us right into our investment analysis. We always ask, would Warren Buffett buy this?
The ultimate litmus test, so the Buffett framework. First up is the economic moat. Does Netflix still have one?
It's a fascinating split decision here. On the moat, the durability of the business, Buffett would likely say yes, emphatically.
Because of the pricing power.
Huge pricing power. Think about it. They raised the premium plan to around $22.99. They cracked down on password sharing, which is a price hike for millions of people. And what happened? Did everyone quit?
No. Churn stayed flat, around 2 or 3%.
That is the definition of a franchise. It has share of mind. The Netflix effect creates cultural FOMO. It's become a utility. So yes, the moat is wide and deep.
Okay, so the business is great, but Buffett cares just as much about the price and how management spends the money.
And here is where Netflix fails the test, specifically the outsider test on capital allocation.
Is it the valuation of the stock itself?
Partly. The PE ratio is somewhere between 35 and 44. I mean, that is way above the value benchmark of 15. It's priced for perfection. But the bigger issue for a conservative investor is the debt.
To pay for Warner Bros.
Yes. To fund this deal, they're using cash, but they're also taking on about $42.2 billion in bridge loans.
Oof, $42 billion in new debt. That's significant.
It is. And remember, up until yesterday, they were talking about buying back shares. Now, all share buybacks are paused for this empire building. Buffett hates that, especially when it puts the balance sheet at risk.
One of the sources in our stack noted that Netflix is voluntarily swimming naked.
That's the quote. Leveraging up right before a potential 2026 recession. If the economy tanks next year and people do start canceling to save money, Netflix is suddenly stuck with a massive interest payment on $42 billion of debt.
That is not a position you want to be in. So they have the moat, but they're buying a very expensive castle and borrowing the money to do it.
Precisely. And that leads to the execution risk. Buying the assets is one thing. Integrating them is something else entirely.
Which brings us to the scuttlebutt. Philip Fisher's term for the gossip on the ground. What's the scuttlebutt on this merger?
The scuttlebutt is alarming. You have to understand, Netflix has a very specific, very intense culture. They have the keeper test.
Right, I've read about this. If your manager wouldn't fight to keep you, they should fire you. It's brutal.
It's high performance, high pay, low job security, very Silicon Valley. Now, contrast that with Warner Bros., a legacy Hollywood studio, heavily unionized. It runs on relationships, tenure, a certain artistic pace.
I can see the clash coming a mile away. You have data-driven tech bros colliding with old-school cinema purists.
The reports from the ground say that Warner Bros. Employees are scared and prepared for the worst.
Yeah.
They're expecting a bloodbath.
And if you destroy the morale of the creative talent, don't you destroy the value of the studio you just bought? Christopher Nolan isn't going to work for an algorithm.
Exactly. And we're already seeing signs of Netflix's own culture shifting. They recently changed their famous culture memo. They moved freedom and responsibility away from the headline.
That feels like a sign of corporate aging, becoming less of a rebel and more of a bureaucracy.
Or calcification. And beyond culture, there's regulatory risk. We can't ignore Washington. This is a massive consolidation of power.
The government has to be looking at this.
They are. And the contract has a terrifying clause. If the FTC or DOJ blocks this deal, Netflix owes a $5.8 billion reverse termination fee.
Wait, if the government says no, Netflix just has to write a check for $5.8 billion for nothing.
$5.8 billion of shareholder money. Gone. Evaporated. Talk about high stakes.
That's unbelievable risk. Okay, let's talk Turkey. Valuation. The stock is around $87, $89 post-split. Is it worth buying?
Well, the discounted cash flow analysis in the report tries to find the intrinsic value.
Walk us through the scenarios.
Okay, so if you assume a no-growth scenario, which is harsh, but it's a baseline, the intrinsic value is around $22 a share.
And it's trading at 87. Wow.
Right, so the market is pricing in huge growth. Let's look at a conservative growth model. That gets us to about $38 a share.
Still less than half the current price.
Even if we go with an optimistic growth scenario, and this assumes 14% free cash flow growth every single year, which is aggressive, the intrinsic value comes out to about $59 a share.
So even in the best case scenario, the stock is trading almost $30 higher than the model says it's worth.
Exactly. The conclusion is that the stock is priced for perfection. The market is assuming a perfect merger, massive ad growth, and no recession. There is zero margin of safety.
That is a tough tightrope to walk. It sounds like the learner takeaway here is caution.
For the learner profile, the takeaway is nuanced. Netflix is the undisputed king of streaming. It's a great company. But as Buffett would say, a great company isn't always a great price, and the balance sheet is no longer pristine.
It feels like they're trading financial safety for content dominance, betting the farm.
That is the trade-off. They believe that owning Batman and Harry Potter is the only moat that matters in the end.
It raises a really provocative question for you, the listener, as we wrap up. We've gone from a company that sent DVDs in the mail to a company that is essentially buying Hollywood. If Netflix is absorbing HBO, adding commercials, raising prices, have they disrupted the cable industry only to recreate exactly what they sought to destroy?
That's the irony, isn't it?
Yeah.
We cut the cord, and now we're just plugging it back into a different box. It's the cycle of bundling and unbundling, and we seem to be back in the bundling phase.
And speaking of cycles and valuations, we know a lot of you love tracking these metrics yourself. If you want to keep an eye on whether the market is overheating, like we talked about with PE ratios, there's a great tool for that.
Right. To track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store.
And for our international listeners who want to stay ahead of the curve.
Oh, of Apple Store? Do. Buffett Indicator read?
It's a handy way to see if we are, swimming naked or not. Always good to check the water temperature before you dive in.
Absolutely.
And before we sign off, just a quick reminder about what we've discussed today.
Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you want to listen to our full deep dive about this topic or access more advanced contents, welcome to join Deep Value Club membership or subscribe us on Apple, Spotify Podcasts channel, Deep Value Investing, and lulavc.com.
Thanks for diving deep with us today. Keep watching